Hello everyone, I'm Wall Street Reporter. Today I will talk about the US stock market investment. Today's video will last about 10 minutes and there will be 6 topics. Please subscribe and thanks for your supporting. First of all, investors. Most of the investors are high-frequency trading firms, which accounts for 42.6% of the market. They provide liquidity and dominate short-term trading, significantly influencing market volatility. The rest of them, in the rest of the investors, most of them are the long-term allocation by trading traditional institutions, which influencing pensions and mutual funds, make out 33.4% of investors. They focus on long-term blue-chip stocks allocation, contributing to market stability. The rest of them are retail investors and banks. Retail investors using zero-commission platforms like Robinhood, representing 17.9% of the market. Their trading behavior is most susceptible to market sentiments and short-term. Banks offer corporate financing services and act as a hub for derivative trading. Yet stability is crucial for the market confidence. Next will be the core index metric. Well, when we talk about the US stock market, we indicate 3 major indexes: the Dow Jones, the Nasdaq, and the S&P 500. The Dow Jones Industry Average, composed of 30 blue-chip stocks and weighted by price, offers stability, with a 2025 return of 7.2%. It suits conservative investors seeking steady long-term return. Next will be the Nasdaq Composite, featuring over 3,000 tech stocks and weighted by the market value, has a 2025 return of 19.8%. It appeals to growth-oriented investors due to its high volatility and potential. The last one will be the S&P 500, covering the 500 largest companies by the market value, which has a 2025 return of 20.4%. It offers a balanced investment option, combining stability and potential growth. Next, I will talk about the industry and concept. Well, it has 3 major industries. In the US stock market, the dominance is the technology and communication industry, which accounts for 44% of the market value, and the rest of them is majorly accounted by the diversity of consumer and financial services, including horse tracks like the electronic vehicles and payment system. These areas are closely related to consumers' life, with a strong market demand and significant growth potential. The rest of them are the stability industry like healthcare, agriculture, and other industries like metal production. These industries offer a long-term stable growth potential, making it a preferred defensive investment. So let's be more specific after talking about the industry. So we have AI revolution wave in the concepts, which needs companies like NVIDIA and Broadcom. Next will be the electrification trends. Electrification is a key trend in the global automotive industry, with pioneers like Tesla and Rivian. As environmental awareness grows and policy support increases, the electronic vehicles market has a bright future, and related companies are expected to benefit. Explorations of the metaverse is also a very hot concept, which have a very important direction to the future technology with explorers like Meta and Unity. It will reshape human social, entertainment, and work pattern, means related companies. And next, I will talk about a major stock in the US stock market. We usually talk about the 10 giants, but I will only share 4 giants, since some of them are overlapped. First of all, Apple, next Nvidia, then Tesla, finally Broadcom. Apple is the giant in the consumer electronic field with a 40% service business, which has a larger user base globally. It holds a 7.2% weight in the S&P 500 and significantly influenced the index trend. Next will be the NVIDIA transformation. which is a leader in AI chips, transforming from a hardware manufacturer to a computing platform. With an 8.4 weighted in the Nasdaq, its technological innovation and market expansion are crucial for the tech sector. Next will be the Tesla leading position. Tesla is a giant in the electronic vehicle field with advanced autonomous driving technology, holds a 3.9% weight in the Nasdaq. Its market share and technological innovation make it a focus of market attention. Finally is the Broadcom, which is a well-known semiconductor company, expand its business through mergers and acquisition, with a 2.1% weight in the S&P 500. Its influence in the chip market is vital for the related industry chain. So after talking about the market, the stocks, let's analyze the historical cycles and the driving factors. Well, from 2029 to 2019, the US stock market enjoyed a 10-year bull market driven by the quantitative easing, with strong market confidence and stable economic growth. From 2020 to 2021, the liquidity phased after the pandemic, supported by the Federal Reserve news policy, saw a particularly strong performance in tech stocks. However, in 2022, because of the adjustments and news cycle because of the adjustments, the Federal Reserve interest rate hike led to the decline sharps in tech stocks and market adjustments. In 2024, the AI revolution drove the US stock market into a new cycle, with a strong performance in related sectors and gradual market confidence recovery. So we can easily observe that the core driving factors are impact of macroeconomic conditions, changes in policy environment, and global interconnection risk. GDP growth rates, well, about the macroeconomic condition, GDP growth rates and inflation curve are key macroeconomic factors affecting the US stock market. With the economic growth strongly and influence moderate, corporate profit increase and the market performs well. Conversely, the market may face adjustments. Next, the change in the policy environment, tax rate changes, and regulatory policy significantly impact the US stock market. Tax cuts can boost corporate profit expectations and drive stocks price up, while strict regulation can increase corporate costs and support market performance. For example, the tariff war between America and China significantly negatively impacted the US stock market in 2018 and 2025. Also, the global interconnection risk, the supply chain risk, and the geopolitical conflicts are external risks for the US stock market. The global supply chain disruption can increase corporate costs and affect profits, while political conflicts can cause market panic and short-term volatility. So, for beginners, first of all, build a foundational as a foundational building stage. The new investors need to adapt to the T+0 trading rules and lock price limits in the US stock market. Open SIPC insurance accounts to protect funds, and masters SEC financial statements analyze tools to lay a solid foundation for investments. And then, in the intermediate stage, intermediate investors can learn hedging strategies, such as options predictions, to reduce investment risk and pay attention to sector rotation. In a advanced stage, investors can build a diversified investment portfolio, such as SPY QQQ, for steady assets growth and engage in global assets allocation. Cross-market hedging can help diversify risk and seize global investment opportunity. And here the pitfall checklist. Please avoid using leveraging exceeding 5 times, as excessive leverage can lead to substantial losses. Do not blindly chase meme stocks. which have extremely price volatility and high risk. Well, regularly investing in the S&P 500 index is a sound investment strategy that can diversify risk and achieve long-term return. Diversify investments across sectors to avoid over-concentration in one area, using hedging tools to protect your investment portfolio and reduce market volatility risk. And this is today's video. Thanks for watching and please subscribe.